Welcome everyone. I'm excited to welcome you to today's presentation. We'll be exploring the fascinating topic of liquidity in Forex trading. The presentation is brought to you by Software STC Market Bull. Today, we'll cover what liquidity means in the Forex market, why it's so important, and how it impacts trading strategies. So, let's dive in and discover the essentials of liquidity in Forex trading. Let's talk about liquidity in Forex trading. Essentially, liquidity refers to how easily you can find buyers and sellers in the market at any given time. It's a key factor because it determines how smoothly transactions can go. When liquidity is high, it means there's a lot of activity, making it easier to execute trades quickly and at desired prices. This is especially important for large institutional orders, where any delay or price slip can have a significant impact. Understanding how liquidity works helps us grasp the overall market dynamics and ensures we're making informed trading decisions. In short, liquidity keeps the market running efficiently and allows us to trade confidently. Let's take a moment to understand the difference between buy-side and sell-side liquidity. These are fundamental concepts that influence how markets function. Buy-side liquidity refers to the willingness of investors, like asset managers or hedge funds, to buy securities at certain price levels. Essentially, they provide the demand side of the market. On the other hand, sell-side liquidity comes from entities like market makers and dealers who are ready to sell securities. They supply the supply side of the market. Understanding these two types of liquidity is crucial because they impact price movements and market stability. When buy-side liquidity is strong, it can support higher prices, while robust sell-side liquidity can keep the market from falling too sharply. Now let's think about liquidity behavior. It's not static, it fluctuates based on market conditions, news, and investor sentiment. Recognizing how these different types of liquidity behave helps us anticipate market shifts and make better trading decisions. Connecting this to our overall theme, grasping the nuances of buy-side and sell-side liquidity enables us to better understand market dynamics and improve our strategies in managing risk and execution. Retail traders often place their stop losses at obvious levels, like just above recent highs or below recent lows. And the reason they do this is because it feels logical. It's a place where they think the market might turn or where they want to protect their positions. But here's the interesting part. These common placements actually create what we call liquidity pools. These are areas where a lot of stop losses are clustered together. And guess what? Smart money, or the big players, are well aware of this. They target these liquidity pools to trigger the stop losses, and then use those movements to find potential entry points themselves. So, understanding where retail traders tend to place their stops is crucial because it reveals where the market might be vulnerable, and where the smart money might be lurking, ready to take advantage. This is a key concept to keep in mind as we move further into the idea of market manipulation and strategic trading. Now, let's take a closer look at these entities and their role in the market. They engage in large volume trading, which means they execute big trades that can significantly influence market movements. They leverage their deep knowledge of market dynamics to develop strategies that capitalize on liquidity pools and retail trader behavior. Essentially, they understand where the liquidity is and how retail traders tend to behave, which allows them to make more informed and strategic trades. When we talk about smart money, we're referring to institutional players like banks, hedge funds, and market makers. These entities have the resources, expertise, and influence to impact market liquidity and pricing. They are the key players who set the tone in the markets, often moving prices in ways that retail traders might not anticipate. Recognizing the behavior and strategies of smart money helps us better understand market shifts and make more informed trading decisions. So, in summary, smart money's actions are a major factor in market movements, and understanding their strategies gives us insight into the broader market dynamics at play. All right, let's talk about a crucial aspect of retail trading in the Forex market. Approximately 75% of retail traders, which is a significant majority, tend to lose money consistently. Now, the main reasons for this are poor risk management and a lack of understanding of liquidity dynamics. When traders don't manage their risk properly, they often expose themselves to unnecessary losses. And without a clear grasp of how liquidity works, like where the big money is flowing, they're at a disadvantage. This is exactly why they become targets for what we call smart money, the institutional players who understand these dynamics inside and out. Recognizing this pattern helps us see how important it is to develop solid risk management strategies and a deep understanding of liquidity if we want to avoid falling into the same trap. This ties into the overall theme of the presentation, understanding the true mechanics behind the market and playing smarter than the average trader. All right, now let's talk about a liquidity grab. This happens when the price sweeps through equal highs or lows, essentially taking out stop losses that are sitting just beyond those levels. Once those stops are triggered, the price often reverses quickly in the opposite direction. This rapid move can seem chaotic, but it's actually a sign that smart money is entering the market. They use these liquidity grabs to collect orders and gain an advantage. Understanding how these moves work is crucial because it helps us predict potential market reversals and identify where the big players are positioning themselves. So, recognizing a liquidity grab is a key part of understanding the overall mechanics behind market moves. Now, let's talk about buy-side liquidity scenarios. What we often see is that institutions, or what we refer to as the smart money, take advantage of retail stop losses that are placed just above equal highs. These are the points where retail traders tend to set their stops, often thinking the price will reverse or pull back. What happens next is that the smart money triggers these stops intentionally. When these stops are hit, it causes a rapid price spike, almost like a quick surge, because it triggers further buying or selling activity. These spikes create a perfect opportunity for larger players to start their large-scale selling from what we call premium zones, areas where the price is relatively high. So, instead of buying into weakness, they're actually selling into these spikes, pushing the market in their favor. This dynamic is a core part of understanding how liquidity is built and exploited on the buy side. Recognizing these patterns helps us anticipate potential moves and understand the broader market structure, aligning with the overall theme of market manipulation and strategic positioning. Now let's take a closer look at sell-side liquidity. Essentially, this occurs when retail traders place buy orders with stop losses set below the recent market lows. These stop-loss orders create clusters of liquidity, which are like pools of potential orders waiting to be triggered. Institutions and larger market players watch these clusters carefully. When they see these stop orders, they can intentionally trigger them, causing the stop losses to be hit. This action allows these institutions to secure lower entry prices for their own bullish moves, effectively taking advantage of the retail traders' risk management strategies. Understanding this dynamic is crucial because it highlights how the market isn't just driven by supply and demand, but also by the strategic placement of orders and how larger players can capitalize on retail traders' setups. It ties back to the overall theme of market manipulation and liquidity, showing us the importance of being aware of where these liquidity pools are located and how they can influence price movements. Now, let's take a closer look at the premium and discount zones. These are critical levels on the chart where the price is considered either overvalued or undervalued. Recognizing these zones helps traders determine potential entry points, especially when considering liquidity availability and the overall market structure dynamics. When the price reaches these zones, it often signals a possible reversal or continuation, depending on the context. Next, we have the concept of a change of character, or CHoCH. This is a key signal indicating that the market might be shifting direction. It often aligns with liquidity grabs, which are moments when the smart money may be initiating or exiting positions. Spotting a CHoCH helps us understand when the market is transitioning, giving us clues about upcoming moves. Then there's the break of structure, or BOS. This occurs when the price breaks through a significant high or low. It's a strong indication that market sentiment could be changing and that new liquidity is now available. Recognizing BOS helps us confirm whether a trend reversal or continuation is likely. Finally, Understanding how supply and demand, or SMC, integrates with market structure and liquidity is crucial. It provides a comprehensive view of how institutional players operate within the market and how their actions create these structural shifts and liquidity pools. Together, these concepts form the foundation for making more informed trading decisions, aligning with the overall theme of understanding market behavior and smart money movements. Many retail traders often fall into common traps that can really hurt their trading success. One of these is placing stop losses at obvious levels, like just above a recent high or below a recent low. While it might seem logical, it can also make your stop vulnerable to being hit by market noise or false breakouts. So, it's important to think carefully about where you set your stops, aiming for areas where the market genuinely shows support or resistance, not just obvious points. Another mistake is trading without confirming liquidity. That means jumping into trades without checking whether there's enough buying or selling interest to support your position. If liquidity is thin, your trades might get slippage or might not execute at your desired price, which can be costly. Always look for confirmation that the market has enough volume, especially around key levels, before making those trades. Understanding these pitfalls is crucial because it ties directly into our overall theme of developing a disciplined, strategic approach to trading. By avoiding these common errors, you can improve your effectiveness and make more informed decisions, ultimately increasing your chances of success in the markets. Let's wrap up with a crucial takeaway: trade smart. Embracing liquidity concepts is essential for achieving success in trading. Understanding how liquidity works helps us make smarter decisions, avoid unnecessary risks, and seize the best opportunities. When we grasp liquidity, we can better gauge market conditions and time our trades more effectively. Remember, integrating these concepts into your strategy aligns perfectly with the overall goal of becoming a more disciplined and informed trader. So, stay smart, stay adaptable, and keep liquidity at the forefront of your trading approach.